Hey, what's going on, everyone? Welcome to another show of the Savvy Real Estate Investor podcast. We have today Matt Hansen with us. He is a retired corporate executive that transitioned to full-time real estate investor. His investment portfolio includes over 2,000 units of multifamily apartments located in Texas, Tennessee, and Florida. He is passionate about helping others avoid the volatility of the stock market by passively investing in real estate. Matt, welcome to the show.
Thank you very much. Appreciate you having me.
Man, you're my kind of guy. I like those states. I invest in those same states, and I am very passionate as well as to share my knowledge with other people on how they can make money by investing in real estate. Um, let's bring it back and walk us through how did you go from being a corporate executive to transition into a full-time real estate investor?
Oh, okay. My wife and I have been flipping houses like 30 years ago before it was a thing. So I've been investing in real estate for a little over 30 years. And about 6 years ago, I'd heard on a podcast this thing about large multifamily syndications. And that's about 6 years ago is when I really focused on the multifamily, did a lot of passive investing first to learn the ropes, understanding how deals operate and things like that. And then about 2 years ago, I retired as from my corporate gig and is doing this full time, primarily raising capital, running deals, and I've got some excellent partners that I work with.
Love it. So you said 30 years you were flipping houses. How long ago did you find out about syndications?
About 6 years ago.
About 6 years ago. How did you find out about syndications?
Yeah, I was just on a podcast. I was listening to a podcast. I think it was the Real Estate Guys, which is one of the oldest podcasts around. And somebody came on there and, they were talking about syndication. I'm thinking, hold it. And I was just moonlighting for fun, flipping these houses. We would hold them for a year. So we only have long-term capital gains on it. We take our time in the evenings and the kids would come and help paint and do stuff like that. And I was working while I was listening to that podcast. And I thought, hold it. I'm doing this fun for a hobby and everything, but it's physical work. I would do everything, electrical, plumbing, you name it. Because it was fun. It was just a hobby. And I thought, hold it, that's scalable. Because I was originally going to buy a whole bunch of houses. One thing and hold it. I can just buy one apartment complex, and work with other investors to bring in the cash and all that. Much less work. You have a professional property manager dealing with all the tenants, toilets, and termites. You have an asset manager. One of my partners always manages the property manager. So it's a pretty big no-brainer that are like, okay, I was glad I did that because we'd flip houses on and off throughout the years. We never rented them out, so I never was a landlord. I didn't want to be one. But the tax is so heavy on a flip because it's capital gains or whatever. So it was just, and it wasn't scalable. And you hear most people start in single family, move to large multifamily because it's not scalable. You don't want to own 100, 200 houses. I do know some people that have, and they're selling them all off and they're getting into multifamily because they just don't want to deal with the headache of all that. So that's one of the big benefits of multifamily.
You touched on something interesting that I always reflect on, that many people go from single family to multifamily, but I've never seen anybody go from multifamily to single family.
It never happens. It never happens. And those that own, I know a guy in Florida that I think he has several hundred units or several hundred single family homes, and he's selling them off little by little by little. And then he's throwing his money into passive investing in large multifamily.
And what you're just saying there for the audience, something I was just at a meetup. We have a monthly meetup, and I was talking exactly about this topic yesterday, that when you have single family homes as a rental property, when you start selling them off, you're selling them based on comps, as opposed to selling an apartment complex that is based on multiples of the income, which you can control, right?
Yes. You're at the mercy of the market. Yes.
Yep. It's big difference. Mm-hmm. Dude, I want to bring it back because you brought a couple cool, good points there. So you kind of brushed on it, very subtle, but you said you were holding flips for at least a year, so it will turn into long-term capital gains, right? So
yes,
pretty golden nugget there. So break that one out.
If you're in the highest tax bracket, you're paying 38 plus local. I mean, I was up to 50% taxes on something that you turn quickly. That's why the flippers, I don't know how the margins have got to be huge. Like our houses, we did I don't know, maybe 15 houses, and the profit would be anywhere from the worst, I think, was 12 grand. The best was 65,000. But if you have to give half of that up, if you did it within less than a year, you're paying your earned income tax bracket. And if you're in the highest tax bracket, that's what you pay, plus your state taxes. So I knew enough that, hold it, I'm going to do all this work and make 6 grand on a $12,000 deal. No, I want the full, a fraction of that in terms of, we got down to what, 25% or 15% at the time of taxes versus 50. So it just made sense for me. And it was a hobby. It wasn't, I put one of my daughter through college, a couple of the flips that we would do. So it was very strategic, very analytical in terms of, I have a minor in economics and I'm a business major and all that stuff. I'm thinking I got to do what's best for financial, because people just look at the dollar signs and don't realize, what are you really going to take home? And that's what I calculate. That's why we decide, okay, we're just gonna do it one at a time, hold it for a year, and then sell it and, pocket much more money.
Yeah. It's not about how much you make, it's about how much you get to keep.
Yes. Right? I love that phrase. You're perfect. You got it.
You said that you were not keeping any single family homes. You never wanted to be a landlord. Why is that?
No. My parents, actually my grandparents, used to own a small apartment complex years and years and years ago. And so my mom would always say, no, you never want to be a landlord, never want to be a landlord. So I thought, okay, I don't want to be a landlord. And she was right in that respect in terms of single family homes, because it is not I hear all the nightmares and the hassles and all that. And you can hire a property manager for a single family home, but expect to give up 10 to 15% commission to them, or the property management fee. In our large apartment complexes, it's like 3.5% we pay our property managers, because they're large. They're 200 unit plus apartment complexes. So, you can do single family and hire a property manager, but they're going to eat up a lot of your profits.
So far, we have 2 problems that we can see in real estate, which is the taxes, tenants, and termites. Can those things be handled by doing something else in real estate?
Yes. So that's why the syndications are perfect for this, because they're tax advantage. You'll get bonus depreciation and all of those things, which you can talk to your CPA. I'm not a licensed CPA or anything. You can use that to offset some of your income, your other passive income. And if you're a real estate professional or something like that, you can offset 1 for 1. So if you get $100,000 of depreciation, you can take that and apply against $100,000 of your other income if you qualify through that. Again, talk to your CPA, but that is super powerful. I mean, this year we had well over 6 digits of, write-offs, paper losses, but yet we made money on our apartments. And I was use that to offset some other income. So people don't understand. You really do. It's kind of deeper than we want to get into here, but you need to have an accountant that understands this. And it's a very, very powerful tool.
Yeah, for sure. Once you start getting into using all these tax write-offs, that the powerful strategies that come with real estate, for sure, don't try to do this. No, don't do it at home, kind of thing, right?
Exactly. Don't try this at home.
No.
I'm a trained professional, and even I have great accountants. I don't know all the details, and ins and outs. But you do need to, if you're getting into syndications, you make sure your CPA clearly understands the benefits of it, because you hear a lot of CPAs don't understand it. So their investors aren't taking advantage of a lot of these things. So that's really important.
Yes. Yeah, for sure. You will, whatever it costs, many people may hold back on using an accountant because of the cost, but dude, whatever, it will be well worth it, whatever money you pay the accountant to make sure your taxes are done correctly. And they'll probably be able to save you more money than you even the cost of the accountant. It will make up. Yes. So you say you started listening to a podcast. That's how you found out that syndications were even a thing, right? Mm-hmm. How does someone get started investing in the syndications?
It's kind of tricky, because you really need to know somebody personally to get in these deals. And it's a little secret that Wall Street does not want you to know about. Everybody knows about stocks, mutual funds, bonds, and ETFs and all these things, because Fidelity, Vanguard, they have billion-dollar advertising budgets. So that's where everybody puts their money, in the stock market. I was one of those schmucks. 33 years ago, I was told, put your money in your Fidelity 401k, and it sat there and it built into millions. And then I wanted to retire at 52, and I can't touch that money without paying a huge penalty. Had I known this stuff, I would have said, okay, well, I'm going to max out, I'll match the employer matching. And I would have put it in something else, maybe a Roth IRA, but it wasn't available originally when I started. But there's other things you can do, or invest in real estate, tax advantage things. So you really need to educate yourself. I think that's a big disservice, that unless you know somebody like, Sach and I, you're not going to get in on these deals. They're just hard to come by. You really need to know someone. So that's why I think it's important. And I love the fact that you're having this podcast to share this with people and say, hey, you can do this. It's not just for the ultra rich. Used to be the only ones that could do these types of investments. Now we're making it available to most anyone.
Yeah, and you touch a very important point, right? Because there's this may be a little bit too in depth to go into, but so we have 506B deals and we have 506C deals, right? And what you were saying is you have to know people doing it, because 506B deals cannot be advertised, right? So Matt and I may have some deals right now that you may not know about, because we need to have a pre-existing relationship before we can even tell you about these deals. So so it's important that you connect with people that are in this industry doing deals, in that way you can become a part of them, right? Luckily, I forget the year when 506C became a thing, but
2012, I think, is the
2012
Jobs Act. 2012, the Jobs Act, I think, would allow that. Yeah.
506C deals are able to be advertised, and you can see them everywhere. But the downside, or the caveat to that, is that you need to be an accredited investor to be able to invest in those deals. And so if you're not accredited, then you're out of the game, right? Again, to me, it's a Wall Street plot thing right here, right?
Oh, it totally is. They control this regulation, the SEC, and how are they influenced by, little conspiracy theory here. But it's true. They don't want you to know you can do this. Right now, fortunately, I've got a 506C, which I can advertise, and a B that I can't talk about. So my C, I can say, hey, yeah, you know what? We got a $43 million deal in Jacksonville, Florida right now, that if you're a accredited investor, which means you have to have a net worth of over $1 million, not including your primary residence. So you live in California, you can't count the house you spent $200,000 for, and it's $1 million now. So or you have an income of $200,000 a year yourself, or $300,000 with a spouse. So those are the qualifications. So the hurdle's kind of high on those. And it is more challenging to raise funds because fewer people meet that criteria. Then the other one that you were mentioning, that I have another deal, which I can't talk about. I can only have friends and family, people I'm acquainted with. And I've got a distribution list of like 500 people that I know, that they get that because I personally know them. But I can't take their money unless I know them and I know their financial situation. It's really to protect the investors. And I do like that about it. You need to make sure you're not taking somebody's last $50,000.
Yeah, absolutely. Yeah. And from our, like, it wouldn't be smart, right? Because a lot of these deals were in it for 5 years, and if you suspect that someone might need that money, I personally don't want you to invest in this deal, because we're going to be partners for quite a while, right?
Yes.
And so awesome. So connecting with people, getting educated is a way to get started investing in syndications. So let's say I already did the research, right? I'm seeing deals. What are some critical numbers and stats that you must review before you say, I like this syndication, I want to invest in this?
Great question. So before you start investing, just like anything else, you need to do your due diligence. Say, okay, how much am I willing to invest? Is it 50 grand, 75, 100? I need to know it's going to be tied up for, depends on the deal, 5 to 7 years, though we've had deals now that we've turned in 2 years, but that's because the market's just been crazy. You need to set that criteria. And then how are those funds going to come through? Is it cash from the bank? Are you going to cash in some CDs or money market or whatever you got sitting around? Or you can take retirement funds. And that's what I did when I left, is my primary employer, is I rolled those monies from the Fidelity IRA to a self-directed IRA. Now I have checkbook control, and I can invest with, there's some parameters around that. I can invest passively in real estate deals. And we also do some venture capital investing and lots of other things, fun stuff. So that opens a door that if you're retired and you've got millions sitting in the stock market locked in your 401k, it's really not locked. Wall Street wants you to think it is, but it's not. You can transfer those funds into a self-directed IRA and pretty much do what you want with it within reason and within the parameters. And I think that's, again, a secret that a lot of people don't know. You have all these retirement funds, and now you're at the mercy of the stock market going up and down. And in 2008, I was down 400,000 bucks at one point. And, you know, you say, oh yeah, well, you're not down unless you don't lose anything unless you sell. But the whole point is I'm down. My baseline is down here. And it took me probably 8 years to recoup where I was, you know, back up to what I'd lost. So yeah, I didn't lose any dollar, but I did lose buying power, and the compounding effect was devastated by that. So I think people don't understand that. They think, oh, well, as long as I don't sell, I don't lose money. But you do. It's opportunity cost on that money. You could have taken that money, put it in real estate, and made 15 or 10% or whatever consistently over those 8 years that took you to recoup your money in the stock market. So I think that's my little pedestal step off my, but yeah, I'm frustrated that people don't know that because they're not told.
Yeah. Yeah. I 100% agree. Can we break down? I think a lot of people fit that mold, that sort of what the footsteps where you left prior to leaving that corporate, of having a lot of money in their 401k. And you mentioned being able to transfer those funds over. Can you explain a little bit more of the steps? Like, let's say I'm listening to this podcast. I have money sitting in a 401k. What do I do next?
Right. So there's providers out there, and because like Fidelity won't let you self-direct your money. They want it locked in the stock market where they make their commissions, whether the market goes up or down. So there's providers, and like you and I know we have contacts. I've got affiliate links on my website that you go and you'll get a discount. You know, you get my discount, basically we give to our investors. So basically you say, okay, you contact Fidelity and say, hey, I'm going to move my money over to another IRA that allows self-directed or checkbook control. And you set up that account with them, and you literally have them, they usually write you a check, but you got to deposit that check back into your IRA, your new IRA, within 60 days. Otherwise you pay taxes. If you do it within 60 days, there's no taxes. No, you can't take that money and use it. You take the check, you redeposit it into your new IRA, and then those monies are now available to invest in approved investments like real estate, precious metals. We do venture capital investing in companies and things like that. And there's some regulations. You can't invest in a friend or a family member's deal. Anybody that's related to you can't invest in theirs. Those are called disqualified. It's got to be a third party, some arm's length away. That's the only really restriction. But it gives you the power to get that money out of Wall Street and put it in something that can really make you money, double your money much more quicker, and diversify. Most importantly, I had all my eggs in the stock market basket years ago, and now I maybe 20% of my portfolio's in it, and the rest is in real estate and other venture capital ventures that we do, and a little bit of crypto in there too. So it's not that bad. And again, somebody like Sancha, I could help you out with those types of things, but don't think that money's locked into the stock market forever, because it's not.
Yeah, there's ways to make it work and work better for you. What's you were saying that man, I forget what I was going with that thought. It was back when we were talking about the putting the money into, as far as the tax advantages that you can get in real estate. Are you still able to take advantage of those if you're investing through an IRA?
Really good point. There's no tax advantage because it's already taxed. So if it's in your IRA, think of it as in a little container in a Tupperware. You've taken your money out of the stock market, put it in another IRA, container, and it's still, you don't get the tax advantages, but you don't pay taxes on it either until you sell it. Depends on what type of, you could have a Roth self-directed IRA, which are really nice because you've already paid tax on that. Or if you have a traditional self-directed IRA where when you pull the money out, just like when you pull it out of the stock market, you're going to pay taxes on it. But while it's in there, it grows, tax-free. There's typically no tax. Now there is some called UBIT taxes, which again, talk to your CPA. There's a little bit of tax that could incur based on the type of self-directed IRA you have, but talk to your CPA. But in general, you don't have the tax advantages because you don't need it. It's already tax-free for the most part.
Cool.
Good question.
Love it. Yeah, for sure. Talk to your this is not tax advice. We're not your accountants, but this gives people a really good idea on what's available out there and what they can potentially ask their accountants. Hey, I heard this and this and this. What are your thoughts, right?
Yes.
Besides people not knowing that syndications even exist. When they do know that they exist, what do you think is why do you think there's a reason that they hold back? Um, I have a big portion of people, obviously, that they invest in our deals, but then there's some of them that I think, dude, this is the best fit for this person, and they just don't feel comfortable doing something that is different that they have ever always done, right? They've always done the stock market. They see this and it makes sense to them. They see the numbers, they're like, yeah, it's pretty good, but I just don't pull the trigger. Why do you think that is?
I think it's fear. It's the lack of education because again, you grew up, put your money in the stock market, put your money in the stock market. And I think the only way around that is education. And that's what I know you and I focus on. That's why I love the Savvy Investor Real Estate podcast, because you educate people to say, here's what it's about. And you get to talk to a lot of experts like ourselves that have done this stuff. And that's another thing, is that make sure when you're investing that the deal sponsor, as we call them, or the person that's the general partner that's running the deal, is just actually almost more important than the deal or the property itself. Because a bad deal sponsor or general partner can make a good deal go south, but a good one can make pretty much any deal work pretty decently. So it's really important. And early on, I did have one deal that I invested in that had a capital call because the people I invested in weren't strong players. One of them stepped away. The guy I invested with stepped away, and his partners weren't very good, and they ran it to the ground. And we ended up making money in the long term, but in the short term, we did have some struggles there. So it's really important to consume podcasts like this, read books, get on people's distribution lists like ourselves, and see the stuff as it comes through the pitch decks, the investor information. Get familiar with it, and once you get familiar with it, you're much more comfortable with it. It doesn't feel like so risky and scary the more education you have. So I think that's the key, is always educate yourself before you invest. And then you'll get comfort. There's a comfort level. But there's some people, like, they'll write a check for $100,000 after, one conversation. There's other people, it'll be a year or two before they decide, I've been seeing this stuff from Matt. He sends out his communications of what he's doing and all this stuff. And then a year or two later, it's like, you know what, I'm ready. And you can do it at your own pace. But education, the number one thing.
Yeah, I love it. I did the same thing when I started. I started getting on people's list, and like you said, and for everyone listening, it's free, right? You can get on people's lists, and it's free, and you will be receiving deals that they're putting out, and just get familiar with the numbers, the metrics, locations, what they're projecting, see previous deals. So Matt, what would you say? You were talking about the operator being more important, almost more important, or more important than the deal itself, right? A good operator can make a mediocre deal work, and a bad operator can make a really good deal drive to the ground. How would you vet someone that is just starting? How can they differentiate a good sponsor from a bad sponsor?
First off, you can see how their communication is. And I've invested with people that are really good operators, but crappy investments. Like, I don't know what's going on half the time. So what is the communication before you start investing with them? Because it's not going to get any better after that. So if they're not quickly responding to you, answering your questions and things like that. So if their communication isn't clear, if their website isn't clear and up to date, okay, are they running the property well? It's kind of like, if you do, one thing good, you do most other things good too. So you really want to be very critical of that, and then see if check their performance of, have they done past deals? How have they went? What are the returns on those past deals? And occasionally, you could speak to another investor. Like, once you're in the circle and people, it's easy to ask around. Hey, what do you think of this operator? Are they good or not? And people, if you're not being recorded, will be very candid about, yeah, I would work with those people, and they're okay, but they're not. Follow-up is terrible on a lot of things. So just really ask around. Once you get into the business, you'll get exposed to a lot more people. But it's really checking their past performance is the best indicator of future performance. We all know that. So check their record.
Love it. So it sounds like you've been around the block a few times, right? Investing in a few syndications. What are some key lessons that you've learned as a real estate investor?
The key is that you do your own due diligence. Read everything. The pitch deck's 12 pages, read all 12. If it's 15, 20, 30, read them all. And ask questions. If you don't understand, if you don't know what an IRR is, ask them, because it's really intimidating when you first start. So get the material, ask questions. And if they're a good deal sponsor or general partner, they're not going to be upset about answering that question because they were new. I was new at one point and didn't know that stuff. I want somebody to be forthright and accepting to say, hey, you know what? Can you answer these dumb questions? And if they're not happy to do that, you don't want to invest with them because they should be willing to help teach you and guide you along the way because you are investing a lot of money with them. You're trusting them with that money. You expect them to perform for you.
I agree.
That's the biggest thing.
Yeah, I agree 100%. Matt, what I know we talked about this a lot, right? We both feel very strongly about investing in real estate syndications and having investments outside of Wall Street. But why do we want to have investments outside of Wall Street?
Yeah, it's just really prudent to do that. Again, I wasn't one of those people. I had 100% of my money in the stock market. And you just need to diversify. It's just good sense. And passively investing in real estate is one of the best risk-adjusted investments you can do. It's actually insured. Your property is insured. You know, we have properties in Florida. If there's a flood or a hurricane or whatever, not only will our apartments be repaired, we get paid for the loss of rent. If, you know, the tenants have to move out, or it's not occupiable. So does Wall Street offer any type of insurance like that? No. And it's a concrete asset, typically never going to go to zero. It's important you invest in good markets like Texas, Florida, Arizona, Tennessee. There's lots of good markets. And in most any state has got a good city to invest in. You know, I don't invest heavily in Michigan, but Ann Arbor, Grand Rapids, great cities to invest in for rentals. So just really know where you're investing it. Is it a growth? Number one, population growth. Number two, employment. There's people in employment there and it's growing. That's a good place to put your money.
I agree 100%. You say you have a 5 or 6 seat deal.
Yes.
Tell us about that.
So it's a 227 units in Jacksonville, Florida. It's we call a light value add. I think we're putting about 6,000 a unit into renovations. It's been managed really quite well. So we're just going to go in there, spruce it up a little bit. And as tenants move out, we will remodel them and bump up the rents. And that's pretty much our business plan. We accept, you know, cash and retirement funds for it. It's a $75,000 minimum investment. We're expecting the cash on cash returns to be about 8 to 9%. And the IRR, which means nothing to you now unless you're in it, is about 15%. Okay. But it's really, I feel guilty. The rents will probably go up $500 a month eventually as we renovate units because it's just been taken care of, but not managed really, really well. There's an opportunity for the rents to go up. And there's so many people moving to Florida that there's no problem. As people move out, you know, they find another place, we renovate it, and then we bring in new people moving into town. So it's kind of a win-win there.
Yeah. We have the same criteria as far as states to invest in. And I'm in Florida. I see it every day. I talk to people every day that are moving in from, like, hey, where are you coming from? You know, you just moved in from New York, just moved in from California, just moved in from New Jersey. If you go to the parks, even during weekdays, before during the weekdays, parks were empty. Now, I hear you even have to make a reservation to even go to the park. You know, they just don't let you in like that. I think that's just system.
And a good point you said is like the people moving from New York and New Jersey, those are the most people moving to Jacksonville specifically. We know the stats. It's incredible. Like 7% of the population that's incoming is from those two states. And they're paying $3,000 a month for rent. And they moved down here and ours was $1,000. Now we're up to $1,500 a month rent for our new renovated units. They're just loving this. It is, you know, the cost of living is much cheaper in Florida than it is in the West Coast and East Coast states. So it's going well.
Yeah. Love it. So that's pretty cool. That's a pretty cool project. So for those can you break down a little bit? You sort of touched on it, but the value add, this is like a very traditional business plan that we do in syndications, right? With multifamily buildings. Can you break down how it typically looks from like the beginning to the end of the project?
Yes. Much like you mentioned before, apartments are based on the net operating income. It's a business. Every apartment's a business. So the more profitable it is, the more it's worth. Unlike a house, you can do everything you want to the house, but if the one next door is not really nice, you're not going to get that much more for your house. But in this case, so what we do is we buy kind of fixer-uppers, not really, they're in nicer neighborhoods, but the apartments just need a little TLC to bring them up to a better standard. You get a little higher clientele that comes in there. Most importantly, we make them safer. We usually we're not in the hood, if you will, but some of the neighborhoods are maybe a little bit, you know, on the verge of turning around. So we'll put gates in the community to keep it safe, so there's no through traffic and things like that. So the tenants, our retention of tenants are pretty high because they're thinking, okay, I like living here. Now it's even safer. And now I can move to a renovated unit and it's going to be a little bit more per month, but I get to stay in the community where my friends and family potentially live and the location I want to be in. So that's what it is. We take it. It's like flipping a house, but it's a 5-year business plan. We take it, renovate it, bump up the rents as people move out. We never evict people. As they move out, we rent. And if they want to move to a new unit, they can. And then after 5 years, and again, we've been meeting our business plan in 2 years just because the market's been crazy. And after 5 years, we typically will sell it because at that point, it needs to be remodeled again. So you typically sell that to another investor or whatever. And what's great for our investors are you've been receiving your quarterly distributions out of the excess cash flow. And then when we sell it, we split the profits, 70-30, usually, 70% is going to our passive investors. And they get 70% of the profit. And that's been very powerful. Though some of the ones we've sold recently, we've almost doubled the money in 2.5 years of our investors. Well, you can't do that in the stock market. It doesn't happen.
Yeah, it's insane.
So that's the value add plan versus somebody. And I've got friends that buy Class A apartments, the luxury ones there's no renovations. You just buy them and run them, but your returns on that are 5 or 6% versus ours could be 8 to 10, or the one of them we did in Memphis, I think we were almost 30% returns because we renovated it, improved it, and then sold it at a much higher price than we bought it for. It's just that simple.
Yeah, I love it. Yeah, there's some class A assets where there is no value add strategy. You're just simply, those are like the low risk, low reward deals, right?
Yes.
So you're just parking your money. There's very little return, but there's literally a trophy asset, right?
Yes, exactly.
And I personally, kind of like you, I like the middle of the road. I won't do like ground up developments. To me, those are like high risk, high reward, but I don't want to go that far on either side of the spectrum. I like to stay in the middle. So like value add, to me, those are like low risk. To me, is low risk, high reward, staying in the middle, right?
I'm with you 100%.
Love it. So Matt, if people were reaching here at the end of the show, if people want to find out more about you, how can they get in contact with you?
Go to hansenholdings.com and it'll be in the show notes. And we also have a free Rethink Your Retirement guide. And it's only like a 9-minute read. It's a couple, I don't know, 10, 15 pages or whatever. And it just basically is an introduction. If you've never passively invested, start with that, read through it all and say, hey, is this something I'm interested in? Do I want to learn more? And then you dig in, listen to more of your episodes, read some books, listen to other podcasts and things like that. So hansenholdings.com, start there, download our free Rethink Your Retirement guide to get you started to see if it's something you're interested in.
Matt, it was awesome having you today. That was a lot of value for everyone listening. And we look forward to having you again once you put this deal together. And you guys, I'll love to have you again so that we can talk about this deal and how it's progressing.
I would love to. And thanks for all you do. You're wonderful.
Thank you, Matt.
Take care. Bye-bye.